Hi everyone, Jeff Yasteen here. I'm excited to become the newest member of the Wealth Press YouTube team, joining Roger, Lance, James, and Rob. And make sure to subscribe to our channel and to follow me on social media. But for now, I'll just cut to the chase here. My video for you today is about Facebook stock. If you own it, I believe you should get ready for a large decline in coming months on the order of 20% or more, and there are downside opportunities for us as well. CEO and founder Mark Zuckerberg is appearing before a congressional committee. He'll answer their concerns about the massive popularity of Facebook's social media platform. Now, that hearing is a political dog and pony show as we head into election season, but those kinds of questions, is Facebook too big, do have a bearing on Facebook's stock price in the months to come, and I'll circle back to that in a moment. Now, if you look around on the internet, you'll see that I recommended buying Facebook stock back on March 10th. Since then, the shares are up about 30%. And as I noted at that time, the shares were exceptionally cheap. They sold off big time after the huge panic-driven sell-off in the stock market because of COVID-19. And in fact, at the time, Facebook was trading at its cheapest level ever relative to the profits the company earns since 2013 when Facebook held its IPO. So why would I now recommend selling it, or if you're more speculative minded, selling it short, or although it's maybe just a little bit early in my opinion, buying put options against it? Well, in mid-June, I put out my first warning about the shares, and since then, they have been unable to participate in the huge uptrend that we've seen in the NASDAQ index. In fact, the NASDAQ is up about 13% or so since mid-May, while Facebook stock has basically gone nowhere. Every time that it's attempted to move above roughly the $242 level, the stock has come in for a round of selling, I believe from institutional players. So plenty of great stocks underperform their indexes from time to time. But when a company's shares cannot participate in what's really a tech rally for the ages like this one, I think it's a warning sign that something else is wrong. Now, what else is wrong with the stock? Well, back in March, as I said, the stock was trading at its cheapest level ever. And that's why I said it was a good buy back then. But now the shares are trading at their most expensive valuation in the last 4 years. And it means that if you're buying the stock now, you're owning basically the most expensive home in the most expensive zip code in the richest part of town. And long term, that is not a way to make money in the stock market. Now, look what's happened to Facebook's profit estimates. What analysts expect the company to earn over the next 12 months. If we look at those estimates have been cut from more than $9 a share before COVID-19 to around $7.50 a share. That's expectations now. Now, it's true that Wall Street analysts do expect the company shares the profits to move up to $9 a share next year and roughly $12 a share in 2021. But those estimates are based on certain assumptions that the U.S. economy will rebound strongly and basically pick up where it left off before the COVID-19 crisis without missing a step. And to me, that looks increasingly unlikely at this point. If the economy slows, so does ad spending. If ad spending goes down, so does Facebook's stock price, in my opinion. Which brings me to my last point. Mark Zuckerberg's appearance before the House Judiciary Committee, which is exploring allegations of anti-competitive behavior on the part of Facebook and also Amazon, Apple, and Google. That's 4 of the 5 so-called FANG stocks. And as I said, the hearing itself is a dog and pony show. Zuckerberg states his case, House members state theirs so they can go back home and look good to their voters. But as I've been warning in recent years about the size of major tech companies as they grow and grow, it will bring more and more scrutiny in Congress and from both parties as lawmakers and regulatory agencies look to limit their size and power. Now, that kind of scrutiny is bad news for any company stock. Now, I saw it happen with Microsoft shares in the last years of the dot-com bubble as the Department of Justice began investigating its alleged monopolistic behavior. Those cases were launched in 1998. Microsoft shares peaked in late 1999, and by the time the case was decided in court 18 months later, Microsoft shares were as much as 60% lower, and I think the same thing will likely happen with Facebook shares going forward from here. Now, we can't know if the same will happen for sure with Facebook shares. Perhaps I'm wrong. In the stock and options markets, Risk goes hand in hand with the rewards. But it's an example of the potential downside opportunity, an extreme one in my belief, that we have ahead of us, again, in my opinion. So lastly, let's do a little technical analysis of Facebook shares, which I believe further supports my opinion. So this is Facebook shares over the past year or so. And if we zoom out a little bit, you can see that stocks had a great run between 2012 here on the lower left up to the present time. It's up, the stock is up about 500% if you count from perhaps a buy-in in July of 2013. So obviously it's had a great run. The big challenge, of course, is holding on to gains for any stock, whether you're owning it for a long term, and let's face it, few people seem to be able to own shares for more than a handful of months at a clip, and that includes a lot of institutional fund managers as well. And if you're just speculating, obviously you're trying to buy it just before it moves higher. But as we've been saying here at Wealth Press, you know, there are other ways to benefit. A stock doesn't have to just move up in order for you to profit potentially. There are options, and of course you can sell short as well. They both have their risks, of course. So the key here in looking at Facebook stock, in my view, is one, I'm going to bring up something called an oscillator. This one, and it's available on, it's no secret strategy. This one's available in pretty much any technical analysis package that you would find online or subscribe to someplace. And this one, you know, the name for it is Awesome Oscillator. Like every technical analysis tool, it's right sometimes and it's not right at others. And obviously the challenge for all of us as investors, as speculators, is picking those points where we're either going to buy and go long or sell short, or obviously buy put options, et cetera, et cetera. And in this case, we zoom in a little bit, you'll see that Facebook's oscillator here moved from marginally negative back in late January. And obviously it was sort of forecasting the COVID-19 crisis, which was emerging in China right around then. And from here, you know, basically mid-February through mid-March was the big plunge for the entire stock market, really, and the S&P 500, and obviously tech stocks as well. Since then, we've seen this huge rebound, and oscillators, you know, tend to be lagging indicators. You're never going to time an entry or exit into a stock perfectly with an oscillator. So I just use them as ways to indicate a trend. And that's important because you know, when you're investing and when you're speculating in any of these sorts of things, that's the main goal here, is to get in line with the trend. If you're going to go short or buy put options, you want to buy them when a stock is in a downtrend. If you're buying call options, if you're going long on a stock, you want to buy it when it's going up, of course. So going back to Facebook stock here, you can see that back in mid-April or so, the stock then emerged, according to this oscillator, back into an uptrend. And look what's happened since then. If you can make out on the oscillator down here, you know, it had its biggest strength, according to the oscillator, its biggest and best strength in terms of an uptrend. And so you can see here, basically in late June, for a period of about 5 days, Facebook's shares had a short-lived plunge. And that was when Coca-Cola and some other large advertisers announced that they were going to freeze their spending on that ad platform for a time. But obviously you can see here that the stock found plenty of buyers as it bounced back here into July. But look at the oscillator here, and you can see where it dipped briefly into you know, negative territory. It dipped below you know, what we call the zero line on this particular oscillator. And since then, we've gotten a positive outcome on the oscillator, but it is below. It's not nearly as strong as we're seeing, or as we saw in May and June. Now, again, the stock, any stock, can continue to kind of trundle along in this sort of situation. Just because the oscillator is weakening does not mean that the stock is going to, you know, plunge off the abyss. But it is a warning sign. And that's something I try to point out to people, because, you know, we can load up all kinds of technical analysis indicators. We can look at fundamental analysis. And you know what? It's not going to tell us the true direction. It's not a crystal ball. All we can do is make our best estimates as to what direction the shares are going to go in, as well as the general technical and fundamental aspects. When you look at Facebook shares, I think this is a perfect time to get out of the stock, perhaps position yourself for downside opportunities, and you can always get back in at some point when the shares are more further sold off and present a better sort of risk reward for investors and speculators. If you like what I'm talking about, make sure to follow me on social media and make sure to hit that subscribe button here at wealthpress.com.